Well, who is one of the best beneficiaries of the wealth effect of a stock market hitting new highs, of a burst of conferences due to the IPO mania, or the beneficiary of the K-shaped economic growth that is obvious all over the place? Yes, it is the hotel industry and its kingpin, Indian Hotels Company Limited. Joining me to discuss the rise and rise of Indian hotels and its stock is the Managing Director and CEO, Puneet Chhatwal. Mr. Chhatwal, thank you very much for dropping into our studio at what looks like a very busy season for you.
Indeed it is, and we are really looking forward to the next few quarters, because this is the real test. The base level is high,
Yes.
but our spirit is higher, and our production in terms of number of rooms, number of hotels is at the highest. So let's see what the combination does.
That is what I was coming to. You know, Q1 was 6% revenue growth and about 11% profit growth. It was hit by elections. But we were worried about Q2 as well, or at least investors were, because there was G20 a year ago, and then Q3 you had World Cup. So when we got the early numbers for July and August from the hotel industry, it was an eye-opener. It was all double digits. So can you tell us how Q2 may pan out? Is it better than you thought?
When we did the Q1 investor call, I already said that July will be 20% higher than July of last year, because there is a pent-up impact.
In spite of the G20 in the base?
In spite of the G20, number one, there were the wedding dates that moved from Q1 to Q2. Number two, there was no more this, election cooling off period. Number three, the extreme heat had left us. Number four, a lot of business activity, and coupled with a lot of foreign delegations coming into India to, work with the newly elected government, whether they were invited by the government or its business houses coming for business. So I think Q2 is exceptional, but, the way to look at it is Q1 plus Q2 together. Okay. And I think the sector is very well positioned to do well on the first half of this financial year.
But Q1 and Q2 together, what kind? Is it double digit? Is it mid double digit? Mid-teens?
I think it should be double digit. Our guidance has been that we'll do double digit growth for this financial year.
Oh, financial year, yes. But coming to Q3 as well, because you will have, or H2, you would have a fair idea of what the bookings are like. In spite of the World Cup in the base, does it look like, it's going to be an easy double digit?
I remain very confident as far as Indian hotels is concerned. I think as far as the sector is concerned, there is nothing that tells us that we should not have growth. Now, whether it's double digit or a very high single digit, that depends on which portfolio you have, what locations you have, what kind of brands you have. So since we operate across the spectrum, from ginger to absolute luxury with Taj, from homestays to home delivery, I think we are very well hedged, and our not like-for-like growth is very high. We are opening now, as of last month, more than 2 hotels a month. So our guidance of opening anything between 25 to 30 hotels in this financial year stands. Okay. And going forward, even marginally higher than that number, because we have more than 100 hotels in pipeline, 112 to be precise.
Okay, so that's about 50% of what is already in operation. So that's
45
okay,
to be precise. So
okay. Now, if you have to tell me, where will the growth come from? Will it come from, or what is the percentage coming from new hotels, from increases in tariffs and margins? What would or increases in usage?
Very interesting question. So as we changed the business model, if we looked at the number of hotels, what we had 6-7 years ago, then that would not correspond when somebody tries to understand the top line. Because we really delivered on our promise of a balanced portfolio of asset light and asset heavy growth, which was 50-50. Slowly it moves to 40-60. So if we talk about system-wide, is the terminology the hospitality sector uses, or enterprise level revenue, then we would have more than doubled the total revenue. But in this 5-6 year period. if we looked at the consolidated basis, then we have had an increase of 77, 78%. So going forward, I think it will be more or less a similar story because we are not going 100% asset free. We changed the terminology and said it's capital light or capital heavy. Capital light includes operating leases, which is based on a rev share with a landlord. So you don't, capitalize them on the balance sheet. And capital heavy is what you capitalize on the balance sheet. And we believe that that is really the sweet spot, which we have found, and that is making the operating leverage results very high on the capital heavy side, and the margin expansion is coming through the capital light.
Okay, so let me still use the word asset light and asset heavy. You said that you've moved from 50-50 to, probably 40-60 now.
Correct.
What's the goal? Like in 2 years, can it even go to 30-70?
As long as our growth numbers are not, challenged, we want to keep growing at a very strong pace in the Indian subcontinent. And asset light is a good enabler for that. Further, it also helps you to keep growing the margins or keep maintaining those even if there was some kind of sectoral headwinds coming your way. Having said that, one of my key learnings is that if you don't invest in strategic opportunities, in margin enhancing assets, and secure for your brands those key locations and develop destinations in the spirit of Tata Group like we've done over a century, then you lose the competitive advantage. So we would not be having 40 outlets in Goa, including our homestays, had we not been the first one in the 70s to build Fort Aguada. We would not be where we are in Kerala today had we not gone as the first mover in God's own country. Similarly, in Havelock, and as we speak, we are in the final stages of getting the construction permit for the 2 islands in Lakshadweep. So I think these are strategic investments, very strategic business initiatives.
So they will be capital heavy, but...
They will be capital heavy, but will also give you the first mover advantage.
At a later date. Okay, now your margins are about 30%, 28, 29. Now as you get asset light, do you see the margins, say in the next 2 years, crossing 30?
Well, we had in our previous strategy, which we communicated, said we'll do 33%. We finished last year at 33.7. So Q1, Q2, if you get close to 30, the likelihood of exceeding 33 is 99% because Q3 is the best quarter and Q4 is the second best quarter. As I mentioned, because of the change in the business model and operating in all segments, I remain fairly confident that no matter what comes, our ability to deliver 33 or higher is very high. And we are very well positioned to do so.
A final question to you, because I'm running out of time. Over the last 5 years, you say you have doubled revenues. How does it look over the next 5 years?
The going is good. Everything looks good. The pipeline is very strong. And
so
we manage our
pipeline
quite well. India looks good. The GDP growth looks good. The disposable income is increasing because per capita income is increasing. India seems to be moving from number 5 to number 3. And the investment of the government in the infrastructure is going to directly benefit our sector. So I think it's a good time to be in the sector. And within the sector, like you said, what did you say, kingpin or something?
Kingpin of the hotel industry.
To be in that leading position.
We would like to think that we are the Taj of the business media industry. Thank you very much.
As long as you use the name Taj, we are very pleased with it.
Okay, thank you. Thank you very much, Mr. Chhatwal, for joining here. And considering that they look like they will be able to double in every 5 years, this 1 trillion market cap looks like it's 2 trillion, not very far from here. That's the word coming in from Puneet Chhatwal of Indian Hotels. Thank you very much for being here, joining us in this conversation. After a break, time for Chartbusters.